Don't adjust your screen. Not because something broke on your side, but because something is breaking in the market. Right now, silver is living in two worlds. In one world, you have the Western, quote, the price you see on charts, the one everyone argues about on social media. In the other world, you have the Eastern bid, the price real buyers are paying when they actually need metal in hand. And the distance between those two worlds is not a rounding error anymore. It's not a little premium, it's dollars. It's a gap that has reached the kind of number that forces metal to move. The gap is now $8. $8 on the same ounce. Same metal, two price tags. Let that sink in for a second. Pause. Because once a market accepts two prices for the same thing, it stops behaving like a normal market. It starts behaving like a stressed supply chain. It starts behaving like water. It flows to the highest point. And right now, that highest point is China. This is not about hype. It's about gravity. When one region pays more for something essential, supply doesn't ask for permission. It reroutes. It migrates. It disappears from the cheap market and reappears where the bid is real. That is what silver is flowing to China actually means. It means the physical market is voting, and the vote is loud. Now here is the uncomfortable truth nobody likes to say out loud. Charts can lie when the underlying asset can be printed. Paper can be created instantly. Contracts can be multiplied. But ounces can't. You can print claims, but you can't print metal. You can print ownership, but you can't print availability. And in moments like this, availability is the only thing that matters. If you run a factory, you don't care what a YouTube trader thinks silver should be worth. You care if your shipment arrives. You care if your line stays running. You care if your customers get their product on time. So when the price in one region starts pulling away, that's not a fun arbitrage. That's a warning siren. It's the system telling you the cheap price is not clearing the real demand. It's the system telling you someone, somewhere, is paying up to secure supply. And that is why this matters. Because an $8 gap doesn't exist in a healthy, balanced market. It exists in a market where replacement fear is rising. It exists when sellers start stepping back. Think about it like a real person, not like a spreadsheet. If you owned silver inventory and you saw China paying $8 more than the West, would you rush to sell your metal cheaply? Or would you hesitate, freeze, and wait for the higher bid to pull price up? Exactly. Sellers don't have to be evil for this to happen. They just have to be rational. When replacement becomes uncertain, selling becomes risky. And when selling becomes risky, liquidity vanishes. That's when price starts jumping instead of climbing. That's when you get those weird days where it feels like silver teleported. Not because of magic, because the order book got thin, because the asks disappeared, because nobody wants to be the person who sold the last real ounce at the fake price. Now I want to make this interactive because your comments matter for the next episode. Pick one and commit to it. Comment West up if you think the Western price will surge to match China. Comment China down if you think China's premium collapses and the gap closes downward. Comment two prices if you think we're entering a world where regional pricing becomes normal for a while. No vague answers. One of those three. Now here's what we're going to do in this broadcast. We're going to explain how an $8 spread can exist without instantly disappearing. We're going to break down why China is the magnet right now. We're going to talk about the silent force that moves markets before headlines do, replacement cost. And we're going to end with the only daily scoreboard you need to watch if you want to know whether this move is ending or accelerating. But first, let's kill a popular myth. People hear arbitrage, and they imagine a robot instantly flattening all differences. That's theory. Reality is slower and messier. Silver is heavy. It moves through refineries, warehouses, shipping lanes, customs, taxes, and time. And time is the enemy when the spread is screaming that availability is tightening. The spread is not just a number. It's a signal that physical demand is pulling harder than paper liquidity can absorb. So if you feel like the market is acting strange, you're not imagining it. Strange behavior is exactly what happens when the physical market starts dragging the paper market behind it. And today's title is the simplest way to say it. The gap is now $8. Silver is flowing to China. The question is, what happens next? Pause. Because when a magnet pulls, it doesn't pull gently. It pulls until something breaks or until the system adapts. In part 2, we go inside the machine, arbitrage, inventory, and fear. Let's talk about the mechanics, but in plain language. There are only three ways a big regional spread closes. 1, the cheap market goes up. 2, the expensive market goes down. 3, the two markets stop being fully connected, meaning the spread can persist because the bridge between them is constrained by rules, delivery bottlenecks, or settlement games. If you're seeing an $8 gap, it usually means option 3 is quietly growing behind the scenes. Not always with a press release, sometimes with friction, sometimes with delays, sometimes with no inventory available, sometimes with call for pricing. Those little phrases are how real stress shows up. Now, why doesn't arbitrage instantly erase the gap? Because arbitrage is not just buying and selling numbers. It's moving metal. And moving metal takes time. It also requires metal that is actually free to move. That's a key detail most people ignore. A lot of inventory is spoken for. It's committed in contracts. It's sitting in places where it's not economical to ship. It's in forms that require conversion. It's behind paperwork. And when markets get jumpy, paperwork becomes slower. And when paperwork becomes slower, spreads can widen further. Here's another human factor. When the spread grows, sellers become cautious. If you're a dealer or a wholesaler, you don't want to sell into a rising replacement cost environment. Because you can win on today's sale and lose on tomorrow's restock. Replacement cost is the monster under the bed. It's the reason dealers widen premiums even when spot rises. It's the reason liquidity disappears at the worst time. And it's the reason price can gap violently. Now imagine you are a large player in the West. You typically provide sell-side liquidity. You cap rallies. You lean on the market. But suddenly, China is paying significantly more. If you sell too low in New York, you're basically handing free money to anyone who can route metal east. So what do? You step back. You pull offers. You reduce exposure. And the moment the offer side thins, the market becomes jumpy. Buyers don't have to be aggressive geniuses. They just have to keep buying into an empty room. And that's when price starts moving in jumps. This is how the paper market begins chasing the physical market. Not because everyone suddenly believes in silver, because the math forces the convergence. The spread becomes the only indicator that matters. Technical indicators can scream overbought, but spread traders don't care. If the spread is wide, they buy the cheap side. Period. That buying pressure doesn't stop because a chart looks stretched. It stops when the spread closes or when the bridge breaks. Now, let's connect this directly to China. When China is consistently paying more, it does two things. First, it attracts supply. Second, it forces everyone else to reconsider what the real price is. Because a real price is not the last trade on a screen. A real price is what clears physical demand at scale. If the physical clearing price is higher in one region, then the global market has a problem. The cheap price is not clearing reality. That's how you get the word flow. The metal flows. And it flows because someone is paying for certainty. Now, you might be thinking, okay, but can't Western inventories just flood the gap and make it disappear? Sometimes, yes, briefly. But if the underlying physical tightness is real, the flood becomes a trickle. Why? Because inventories are buffers. Buffers are finite. When a buffer is used to suppress price, it eventually runs out or becomes too risky to deploy. And once the buffer is thin, price becomes the shock absorber. That's when volatility becomes a feature, not a bug. Now here's a line that will trigger debate, and I want you to argue in the comments. The market is not deciding silver gas price by fair value. When the market is deciding silver's price by who panics first. Panics first to buy. Panics first to cover shorts. Panics first to secure supply. Panics first to avoid being the last one holding a promise. That's why these moments are violent. That's why they feel irrational. But they're not. They're human. They're institutional. They're fear-driven. And fear moves faster than logic. So here is the key insight for part 2. An 8 gap is not just an opportunity. It's a pressure differential. And pressure differentials always try to equalize. The question is how? Does the West reprice up? Does China premium fade? Or do we get a period of 2 prices because the bridge can't handle the stress? In part 3, we shift from how to why. Why China, why now, and why silver specifically? Let's get very direct. Silver doesn't just move because people like shiny things. Silver moves because it's an industrial input and a monetary metal at the same time. That combination is rare, and it creates explosive behavior when supply tightens. China sits at the center of global manufacturing demand. Whether it's electronics, solar components, industrial electronics, medical devices, or high-volume production that requires silver-based materials, the demand is not just financial, it's functional. You cannot replace silver easily in many critical applications without performance loss, redesign, or cost increases. So when supply becomes uncertain, buyers don't behave like traders. They behave like survivors. They hoard. They front-run their own future needs. They switch from just-in-time delivery to just-in-case inventories. And that behavior alone can pull a market upward even if the world is arguing online about charts. Now add the second force, investors. When macro confidence weakens, hard assets get attention. And here's the thing, when gold becomes too expensive for the average investor, silver becomes the entry ticket. It feels affordable. It feels reachable. It feels like the smaller door into the same room. So when gold is strong, silver often gets pulled behind it. But silver moves more violently because the market is smaller. Capital spillover that barely moves gold can create waves in silver. This is why, historically, silver can behave like gold on steroids. It's not just a meme, it's market structure. Now let's add the third force, strategy. Governments and corporations don't announce everything they're doing. But when markets show persistent premiums, it suggests someone is prioritizing securing supply. Strategic stockpiling doesn't need a press conference to show up. It shows up as, why is the premium still high? It shows up as, why are deliveries slow? It shows up as, why is the gap not closing? And that brings us back to the $8. If the gap persists, it implies the pull is persistent. The pull is not a one-day emotion. It's sustained demand meeting constrained supply. Now, I want you to imagine a procurement manager at a solar manufacturer. Silver cost might be a small percentage of total product cost, but without it, the product doesn't ship. If the manager stops buying silver to wait for a better price, they risk losing 100% of revenue because they tried to save 5% on input cost. That's not smart. That's career ending. So when price rises sharply, the manager doesn't say, too expensive. They say, shortage. And shortage signals trigger more buying. That's inelastic demand. It's counterintuitive, but it's real. The price rise becomes the reason demand increases. Now do you see why this is dangerous? Because the market can enter a feedback loop. Premiums rise, buyers panic, inventory drains, spreads widen, price jumps. And in the background, metal flows to the region paying the highest physical clearing price. That's how China becomes the magnet. Not because of conspiracy, because of industrial gravity. Now, here's the comment bait. And I end up doing it on purpose because I want real debate. If China is paying more for physical silver, do you think the West is underpricing the metal or overpricing the promises? Which one? Comment, underpriced metal or overpriced paper. Pick one. Because this is the philosophical divide in every commodity squeeze. Now let's talk about what people get wrong. They think the story ends when the price spikes. But the story often begins at the spike. Why? Because spikes change behavior. They change dealer behavior. They change industrial behavior. They change investor attention. They bring new buyers. They force short sellers to cover. And that brings us to the most explosive ingredient, positioning. In part 4, we're going to talk about what happens when shorts meet in a liquid market while a regional premium keeps screaming that the cheap price is unsustainable. This is where markets get emotional. Because this is where people get forced to act. When shorts are in control, they rely on liquidity. They rely on the ability to buy back later without moving the price too much. But when sellers step back and the order book thins, shorts lose the one thing they need, an easy exit. In a normal market, covering is a process. In a stressed market, covering is a panic. And panics are not price sensitive. A forced buyer does not negotiate. A forced buyer hits the button. That's why squeezes feel like teleportation. Now, add the spread on top of this. If China is paying materially more, it reduces the willingness of sellers to sell into the West. Why sell at the discount when the premium exists elsewhere? So liquidity thins further, and then any short covering becomes rocket fuel. Here's a simple loop. Price rises a little. Some shorts get uncomfortable. They cover. Covering pushes price up more. More shorts hit their limits. They cover. Price rises again. Meanwhile, sellers are not eager to step in because replacement cost is uncertain and the global bid is higher. So the market becomes one-sided, and one-sided markets move fast. Now, I want to be careful with tone here because people take this personally. This is not about good guys versus bad guys. It's about structure. The market doesn't care who you are. If you're short and wrong in a thin market, you get forced. If you're long and greedy in a whipsaw, you get shaken. The market punishes emotions. But in a scenario where the physical market is pulling higher, the structural pressure leans bullish. Now let's bring it back to real life. Dealers. When spot spikes, many people think dealers will drop premiums because the price is higher. But often the opposite happens. Premiums stay high or widen because dealers fear restocking at even higher replacement cost. They freeze inventory. They switch listings to call for pricing. They slow deliveries. That's not greed, that's risk management. They are protecting themselves from getting wiped out by volatility. And when dealers freeze, retail feels the shortage even more. The screen says one number, your checkout cart says another. That difference is where the real stress lives. Now, here's the controversial statement that will trigger comments. When you see a persistent spread and rising premiums at the same time, you are not watching a normal bull market. You're watching a market trying to reprice reality while the paper side tries to pretend nothing changed. Do you agree or disagree? Comment agree or disagree and tell me why. Keep it respectful, but be honest. Now, what about mining supply? People always say, at higher prices, miners will produce more. True, but not instantly. Mines don't scale overnight. New production takes time, permitting, capital infrastructure. So short term, the system can't just solve a shock with supply, which means the gap can persist longer than people expect. And when it persists, it keeps pulling metal toward the higher bidder. That's the flow. That's why the title matters. Now we have to land this plane. Not with hype, with a practical scoreboard. In part 5, I'm going to give you the simple framework. What signals would tell you the gap is closing safely, and what signals would tell you the gap is about to widen again and turn this into a bigger event. Let's end with something useful, because you can get lost in theories, rumors, and emotional headlines, but a market like this leaves footprints, and you can track them. You do not need to predict the future. You need to watch the scoreboard. Here are the 4 daily signals. 1, the spread itself. If the gap is truly around $8, watch whether it compresses or expands. Compression can happen because the West price rises or because the East premium fades. Expansion tells you the pull is intensifying. 2, physical premiums and availability. If spot rises but premiums stay elevated and inventory remains tight, it suggests replacement fear is alive. That supports the idea that the move is not just paper noise. 3, delivery stress signals. Longer delays, tighter product availability, wider dealer spreads, and more sold-out notices are not perfect data, but they reflect real friction. 4, the macro companion. Watch gold behavior and broad risk sentiment. Silver can move on its own, but sustained system stress moves often show up in gold stability and in how markets treat safety assets. Now, let's be honest, this can get volatile. The market can whip. It can trap both bulls and bears in the short term. The goal is not to be a hero on every candle. The goal is to understand what the gap is saying about the physical market, because that is the core message today. 2 prices for 1 metal means the market is struggling to clear real demand with the posted price. And if China remains the higher bidder, the flow remains the same. Metal flows to the highest clearing price. Now, I want to end with one last comment question because this determines the next video. If the gap goes from $8 to $10, do you want to follow up titled, "If the gap hits 10, the day paper, silver loses control"? Comment make part 2 if you want it. And also drop your country in the comments. I want to see where you're watching from because this is a global story now. Now, final thought. People ask, is silver going up? Sometimes the better question is the pricing system being forced to admit reality? Because the gap is not just a trade, it's a message. And right now, that message is loud. The gap is now $8. Silver is flowing to China. The only question left is how the world responds. Does the West reprice up? Does the premium fade? Or do we enter a period where 2 prices coexist? Whatever your answer is, lock it in below. And if you're new here, subscribe, because we're not doing surface level hype. We're tracking the pressure points as they evolve. See you in the next one.